Investing in stocks often conjures images of meticulous analysis and strategic decision-making. However, an often overlooked risk is not market volatility but the investor's own behavioral biases. As Warren Buffett famously said, "The most important quality for an investor is temperament, not intellect." This underscores the importance of recognizing and managing one's emotional responses and cognitive biases when navigating the investment landscape. Firstly, behavioral risk, or the vulnerability of the investor's own psyche, plays a crucial role in investment decisions. Investors are susceptible to various psychological pitfalls, such as overconfidence, herd mentality, and fear of missing out, FOMO. These biases can lead to poor decision-making, such as buying high in a market frenzy or selling low during a panic. Understanding and acknowledging these biases is the first step toward mitigating their impact on investment outcomes. Furthermore, one common behavioral pitfall is the tendency to be influenced by persuasive marketing and sales pitches. Even seasoned investors can find their judgment clouded by slick presentations and compelling narratives. For instance, a company might present an overly optimistic outlook, glossing over potential risks. Investors must cultivate a healthy skepticism and rigorously verify the information presented to them, ensuring that their decisions are based on objective analysis rather than persuasive rhetoric. Additionally, the emotional roller coaster of investing can lead to impulsive decisions. Market volatility often triggers fear and panic, leading investors to sell off assets prematurely. Conversely, a booming market can incite irrational exuberance, prompting investors to buy overvalued stocks. Both scenarios underscore the need for a disciplined approach, where decisions are guided by long-term goals and sound analysis rather than short-term emotional reactions. Moreover, practical strategies can help mitigate behavioral risks. One effective approach is to implement a systematic investment plan, such as dollar-cost averaging, which involves investing a fixed amount at regular intervals regardless of market conditions. This strategy helps reduce the impact of market volatility and prevents impulsive decision-making. Additionally, maintaining a diversified portfolio can spread risk and reduce the emotional impact of any single investment's performance. Lastly, fostering a mindset of continuous learning and self-awareness is crucial. Investors should regularly review their investment decisions, reflect on their outcomes, and identify any biases that may have influenced their choices. This ongoing process of self-reflection and education can lead to more informed and rational decision-making over time. As Benjamin Graham, the father of value investing, stated, "The investor's chief problem, and even his worst enemy, is likely to be himself." In conclusion, becoming a savvy investor requires more than just market knowledge and analytical skills. It demands a deep understanding of one's own psychological biases and emotional responses. By acknowledging these internal risks and employing strategies to manage them, investors can make more rational and informed decisions. Remember, as Winston Churchill said, "Success is going from failure to failure without loss of enthusiasm." Stay resilient, keep learning, and continuously refine your investment approach. If you found these insights helpful, please like, share, and subscribe to our channel. Together, we can enhance our collective wisdom and achieve greater success in the investment world. Thank you for staying with us till the end. We often overestimate our abilities in life, and this tendency extends to investing as well. From a young age, we're taught to think positively and have confidence in our skills. However, this confidence can sometimes be misplaced and even detrimental. A revealing study showed that American high school students believed their math skills were among the best in the world, while in reality, they were just average. This overconfidence bias is also evident in the workplace. Organizational researchers Tom Peters and Robert Waterman found that 100% of employees rated themselves above average in interpersonal skills, and 94% thought they were athletically superior to their peers. Such inflated self-assessments illustrate how people often overestimate their abilities. Overconfidence may seem harmless, but in the context of investing, it can be quite damaging. Investors who overrate their abilities tend to attribute market gains to their own skill and blame losses on external factors. This is known as fundamental attribution error, where individuals fail to accurately assess the impact of their actions. Such a mindset prevents learning from mistakes, crucial for growth as an investor. Furthermore, overconfident investors might ignore market risks and make reckless decisions, believing their instincts are infallible. This can lead to significant financial losses. Additionally, their self-assuredness might deter them from seeking advice from knowledgeable advisors, depriving them of valuable insights and strategies. To succeed in investing, humility is essential. Recognizing one's limitations and being open to learning from errors are vital traits. By acknowledging that we are not infallible and that the stock market's complexities require ongoing education and adaptability, we can improve our decision-making processes and investment outcomes. In conclusion, while self-confidence can be beneficial in many aspects of life, it's crucial to temper it with realism, especially in investing. As Winston Churchill famously said, "Success is going from failure to failure without loss of enthusiasm." Embrace humility, learn from your mistakes, and continue to refine your investment strategies. If you found these insights valuable, please like, share, and subscribe to our channel. Together, we can enhance our collective wisdom and achieve greater success in the investment world. Thank you for staying with us till the end. Our emotions can significantly impact our decision-making abilities, especially when it comes to investing. Extreme emotional states, whether positive or negative, add vibrancy to life but can hinder rational investment decisions. Social psychologist Jennifer Lerner conducted an experiment demonstrating this effect. Participants watched either a sad movie or a dull clip about fish, then participated in a pen buying and selling exercise. Those who watched the sad movie made less shrewd decisions, selling their pens for 33% less than those who watched the boring clip. This indicates that sadness can make investors more gullible and less decisive. But what about positive emotions, like excitement? Behavioral economist Dan Ariely explored this in his book Predictably Irrational: The Hidden Forces That Shape Our Decisions. He found that students' decision-making was significantly impaired when they were excited. Initially, students gave responsible answers to questions about cheating and unprotected sex. However, after being shown pornographic images, their likelihood of making reckless choices increased dramatically. This highlights how excitement can lead to imprudent decisions, a parallel easily drawn to investing. Investing often involves high stakes and can evoke strong emotions, similar to those felt in Ariely's experiment. The thrill of potentially lucrative deals can cloud judgment, leading to impulsive decisions. Emotions like fear, greed, and excitement can prompt hasty actions that might not be in an investor's best interest. Recognizing this, it becomes clear that managing emotional responses is crucial for making sound investment choices. To mitigate the influence of emotions on investment decisions, one effective strategy is to seek the guidance of an investment advisor. Advisors can provide objective insights and help investors stay focused on long-term goals, reducing the likelihood of making decisions based on transient emotional states. By maintaining a level-headed approach, advisors assist investors in navigating market fluctuations and making informed, rational choices. As we strive to become better investors, it's essential to acknowledge the impact of our emotions and implement strategies to manage them. Understanding our emotional triggers and having mechanisms in place, such as working with an advisor, can significantly enhance our investment outcomes. Remember, in the words of Winston Churchill, "Success is going from failure to failure without loss of enthusiasm." Embrace the journey of learning and growing as an investor without letting emotions dictate your decisions. If you found these insights valuable, please like, share, and subscribe to our channel. By spreading this knowledge, we can collectively enhance our financial literacy and achieve greater success in our investment endeavors. Thank you for staying with us till the end. Don't quit on yourself, keep learning and investing wisely. One of the best investing decisions you can make is to get an advisor. Even with extensive knowledge and careful planning, many investors struggle to maintain discipline and avoid impulsive decisions. This is where the value of a financial advisor becomes clear. Research shows that advisors significantly enhance their clients' investment outcomes, helping them stick to their plans and make better decisions. According to Morningstar, investors with advisors outperform their peers by 2 to 3% annually, a substantial advantage over time. Advisors are especially crucial during market crises. For instance, during the financial meltdown of 2008, many investors panicked as their life savings seemed to vanish. Yet, those who had advisors navigated the turmoil more effectively. Studies by Aaron Hewitt and Financial Engines revealed that advised investors outperformed others by 2.92% during the critical recovery years of 2009 and 2010. Advisors don't merely provide data, they offer vital emotional support, helping clients maintain a level head when the market is turbulent. The role of an advisor extends beyond providing market insights. The best advisors serve as behavioral coaches, offering a reality check against emotionally driven decisions. For instance, they can conduct a pre-mortem analysis, challenging your investment enthusiasm with probing questions about potential pitfalls. While this may seem daunting, it is a critical step in safeguarding against significant losses. If an investment can withstand this scrutiny, it's more likely to be a sound choice. However, not all advisors are created equal. It's essential to thoroughly vet potential advisors, examining their credentials, investment philosophy, and communication style. Crucially, ensure they excel in behavioral coaching. This aspect of their service can make the difference between following a sound investment strategy and succumbing to market whims. Winston Churchill famously said, "Success is going from failure to failure without loss of enthusiasm." In the world of investing, this means continuously learning and improving without getting discouraged by setbacks. Embrace the guidance of a good advisor to help navigate this journey with resilience and insight. If you found this information helpful, please like, share, and subscribe to our channel. By spreading these insights, we can collectively improve our financial well-being and achieve greater success together. Thank you for staying with us till the end. Don't quit on yourself, keep learning and investing wisely. Don't panic about investment panic. Imagine investing part of your life savings in a company, only to hear that it is being investigated for fraud. The immediate reaction for most people would be sheer panic. The media exacerbates this by sensationalizing every dip in the market, preying on our inherent tendency to catastrophize. This psychological trap leads us to imagine worst-case scenarios, such as losing all our retirement savings and becoming financially dependent on our children. However, it is essential to understand that market dips and corrections are a normal part of the investment cycle. When stocks are overinflated, a correction, a drop of over 10% in stock value, often follows as investors sell off their high-priced stocks. This annual occurrence, while unsettling, does not affect the long-term value of a well-diversified portfolio. Reacting impulsively by selling stocks during these corrections can result in significant losses, turning temporary declines into permanent setbacks. Ironically, periods of market prosperity can be more dangerous. High valuations often signal a bubble, which can burst, leading to sharp corrections. While these corrections might feel like crises, they actually make the market safer by bringing valuations back to realistic levels. It's during these times of perceived crisis that the market is adjusting to more sustainable values, providing a more stable foundation for future growth. To be a successful investor, one must develop the resilience to withstand these market tremors. It is crucial to avoid making hasty decisions based on short-term market movements and sensational news. Instead, focus on long-term strategies and maintain a level-headed approach to fluctuations. Winston Churchill's words, "Success is going from failure to failure without loss of enthusiasm," perfectly capture the spirit required for investment success. It's about learning from each setback and not letting fear dictate your decisions. Stay informed, stay calm, and keep your long-term goals in sight. If you found these insights helpful, please like, share, and subscribe to our channel. Together, we can spread knowledge and empower more people to make wise investment decisions. Thank you for staying with us till the end. Don't quit on yourself, keep learning and investing wisely. Learn to identify a dodgy company by evaluating what the management does, not what it says. We've all heard cautionary tales about con artists on Wall Street, and nobody wants to be the next victim of a financial scam. However, spotting these frauds is not as simple as relying on intuition or detecting lies. Research shows that humans are notoriously bad at identifying liars. In a comprehensive analysis of 200 studies, psychologists Charles Bond Jr. and Bella DePaulo found that people can only detect lies by body language 47% of the time. This is no better than flipping a coin. Even experts struggle with this skill. In a prison experiment, law enforcement professionals were tasked with distinguishing between true and false confessions. They succeeded only 42% of the time, underscoring how challenging it is to accurately read deception. As investors, this means we need a more reliable strategy for evaluating the integrity of company executives. The key is to focus on what executives do rather than what they say. Specifically, investors should observe how company leaders are investing their own money. Executives possess the most comprehensive knowledge about their companies. If they are buying significant amounts of their own stock, it indicates strong confidence in their company's future. Conversely, if they are selling off their shares, it could be a red flag. A study by the private investment firm Tweedy, Brown, published in 1992, supports this approach. It found that companies with substantial insider buying significantly outperformed other companies on the stock market, gaining 2 to 4 times as much value over the same period. This suggests that insider buying is a strong indicator of a company's potential success. Rather than trying to interpret the often misleading words of company leaders, investors should observe where these leaders are putting their money. Actions speak louder than words, and by focusing on these actions, investors can make more informed and potentially profitable decisions. The highest price isn't always right, so when investing, go for value over glamour. Imagine paying $52 for an old, burned oven mitt. Now, what if you learned it belonged to Julia Child and got burnt while she made her first ever batch of beef bourguignon? This backstory adds perceived value, illustrating how we irrationally assign worth based on context rather than objective merit. This irrationality extends to investing. Stanford professor Baba Shiv's experiment demonstrated this by feeding participants wine while they underwent FMRI scans. When told some wines were expensive, $90 per bottle, and others cheap, $10, the pleasure centers in their brains lit up more for the expensive wine, despite all samples being identical. This highlights how we often equate high prices with high quality. While harmless with wine, this fallacy can be disastrous in investing. Glamour stocks from startups and fast-growing companies are attractive due to their rapid value increase. However, buying these stocks at their peak can lead to unprofitable investments, as their inflated prices often don't sustain long-term growth and may plummet when the hype fades. In contrast, value stocks, those from smaller, less glamorous companies, are typically underpriced and overlooked. These stocks have greater potential for growth and represent a lower-risk investment. They are like the kid picked last for the basketball team, who surprises everyone with a steady performance, while the popular jock's flashiness fails to deliver consistently. Investing in value stocks requires resisting the allure of immediate popularity and focusing on long-term potential. It involves looking beyond the surface, understanding the fundamental strengths of a company, and being patient as it steadily gains value. This approach minimizes risk and maximizes the chance of substantial returns. In conclusion, be wary of equating price with value. As Winston Churchill said, success is going from failure to failure without loss of enthusiasm. Apply this mindset to your investments, embrace learning from mistakes, and don't be swayed by glamour. Focus on value, make informed decisions, and invest wisely for the future. If you found this advice helpful, please like, share, and subscribe to our channel to help us continue providing valuable insights and increasing our collective impact on the world. Don't quit on yourself, success is just a smart investment away. Thank you for staying with us till the end. Be wary of being seduced by novel and exotic investments. In the early 1600s, tulips became the ultimate status symbol in the Netherlands. People were so captivated by their unique beauty that prices skyrocketed, reaching up to 10 times a worker's annual salary for a single bulb. However, this frenzy ended in 1637 with a spectacular crash, marking the first speculative market bubble. What makes new and exotic investments so alluring? This fascination has led to repeated economic bubbles throughout history. A modern example is the dot-com bubble. In the late 1990s, investors were so enthralled by the internet's potential that they assumed any company ending in .com was a sure bet. For instance, eToys.com, founded in 1997, attracted $8 billion in investments by 1998 despite only reporting $30 million in toy sales. In contrast, the traditional toy company Toys R Us, which had 40 times the sales, received only $6 billion in investment because it wasn't seen as innovative. By 2001, eToys.com went bankrupt and was bought by Toys R Us. This shows how excitement can cloud rational judgment. Similarly, the air travel industry, synonymous with exoticism, has consistently been a poor investment due to its high fixed costs, strong labor unions, and rigid pricing models. These examples underscore the importance of evaluating the substance behind the allure. Just as the tulip bubble eventually burst, so too can any investment that is driven by hype rather than solid fundamentals. So, when tempted by the next big thing, remember to look beyond the surface. Ask yourself if the investment is truly valuable or just another beautiful but hollow tulip. As Winston Churchill wisely said, success is going from failure to failure without loss of enthusiasm. Embrace this mindset in your investment journey. Learn from past bubbles, and don't let the allure of novelty cloud your judgment. Focus on solid, value-driven investments for long-term success. If you found this advice helpful, please like, share, and subscribe to our channel to help us continue providing valuable insights and increasing our collective impact on the world. Don't quit on yourself, success is just a smart investment away. Thank you for staying with us till the end. We need to invest our money according to our personal goals rather than other people's rules. The question of how much money is enough is highly subjective and depends on individual needs and values. While some may look to financial guidelines or compare themselves to their peers, the most effective way to determine this is by examining your unique hierarchy of needs. After basic necessities like food and housing are met, Personal priorities can vary greatly. Some people may prioritize having substantial savings for future security and education costs, while others might value having cash readily available for experiences like travel. Understanding your personal financial goals is crucial for navigating market fluctuations with confidence. For instance, if your financial needs are long-term, such as a 15-year savings plan, market dips will be less concerning because there's ample time for recovery. Conversely, if you need to support an elderly parent with uncertain healthcare costs, you'll need a less risky, more liquid investment strategy. Aligning your financial decisions with your goals can be significantly influenced by how you frame your financial objectives. Language plays a powerful role in financial psychology. For example, during the Great Recession, the Obama administration labeled economic stimulus funds as a bonus to encourage immediate spending rather than saving. Similarly, personalizing your savings can be motivating. Studies show that low-income couples saved more for their children's education when their savings envelopes featured their children's photos. When considering an investment, focus on your specific needs and values. Ensure that your financial strategies are tailored to your personal goals and dreams, rather than being swayed by external benchmarks or societal expectations. This personalized approach not only helps in making more rational investment decisions but also provides a clear path toward fulfilling your unique financial aspirations. Remember, success in investing is about aligning your financial practices with your life goals. As Winston Churchill once said, success is going from failure to failure without loss of enthusiasm. Keep this resilience in mind as you navigate your financial journey. If you found this advice helpful, please like, share, and subscribe to our channel to help us continue providing valuable insights and increasing our collective impact on the world. Don't quit on yourself, success is just a smart investment away. Thank you for staying with us till the end. In reflecting on the intricacies of investing, it becomes evident that the greatest adversary isn't the unpredictable nature of the market, but rather the inherent biases and emotions within ourselves. We're wired to react impulsively to fluctuations, often leading to irrational decisions that can compromise our financial goals. Recognizing these tendencies is the first step toward achieving success in investing. Studies have shown that our confidence in our abilities can often blind us to our limitations. Whether it's overestimating our skill in spotting lies or assuming we can outperform the market, unchecked confidence can be detrimental. Similarly, our emotions, be it excitement or fear, can cloud our judgment and lead to impulsive actions that undermine long-term strategies. One effective way to counteract these tendencies is by seeking outside guidance from financial advisors. Research indicates that investors who work with advisors tend to make better decisions and adhere to their investment plans more consistently. These professionals not only provide valuable expertise but also serve as behavioral coaches, offering a reality check when emotions threaten to derail rational thinking. Moreover, adopting a systematic approach aligned with personal goals is crucial for navigating the complexities of investing. By identifying our unique hierarchy of needs and values, we can tailor investment strategies to suit our individual circumstances and aspirations. This clarity enables us to weather market turbulence with resilience and focus on long-term growth. In essence, the path to success in investing lies not in chasing novel trends or succumbing to emotional impulses, but rather in adhering to disciplined principles and seeking alignment with our personal objectives. By embracing simplicity and clarity in our investment approach, we can mitigate risks and maximize opportunities for financial growth and stability. To our valued audiobook listeners, we appreciate your continued engagement with our content. Your feedback is essential for us to improve and provide you with even better audiobook experiences. If you found value in our content but haven't already, we kindly ask you to consider subscribing to our channel. Subscribing not only keeps you updated on new audiobook releases but also helps our channel grow, allowing us to produce more high-quality content for you. Additionally, liking and sharing our audiobooks with others who may benefit from them would be greatly appreciated. Your support is crucial in ensuring the continued success of our channel, and it's the least you can do to show your appreciation. Thank you for considering this request, and until next time, happy listening. The investor's chief problem, and even his worst enemy, is likely to be himself. Benjamin Graham,